Hi, I'm Steve Brice, Standard Chartered Global Chief Investment Officer. Over the first half of the year, markets have shown remarkable resilience despite a series of uncertainties. We started the year navigating geopolitical tensions, volatility in energy markets, and shifting expectations around central bank policy. Yet global equities have continued to push higher, supported by strong earnings and the ongoing momentum from AI-led growth. As we enter the second half of 2026, the key question is, can markets continue to deliver, or are we entering a more challenging phase? Our view is that the backdrop remains constructive, but increasingly complex. The main theme we are navigating now is what we call shifting sands. Energy prices, central bank policy, investor positioning, and equity supply are all evolving at the same time. And that means markets are likely to become more volatile, even as the broader trend remains supportive. From a macroeconomic perspective, our core view remains unchanged. We continue to expect a soft landing scenario where growth slows but stays positive and inflation gradually moderates. The recent US-Iran interim deal has helped ease concerns around a major energy shock, reducing the risk of a sharp spike in inflation. However, this is not full resolution. Uncertainty remains about how quickly oil supply normalizes, inventories are rebuilt, and demand evolves. While immediate tail risks have declined, energy market volatility is likely to persist. For our Signature CIO strategies, this constructive environment has translated into solid outcomes. Year-to-date returns have been strong across our risk-based portfolios, particularly balanced and growth strategies, which benefited from higher equity exposure. Meanwhile, income and conservative strategies have continued to deliver stable returns, supported by carry and diversification. So how are we positioning portfolios as we move into the second half of the year? We continue to position for upside in global equities, while maintaining diversification and hedges to navigate potential volatility. Within equities, we remain overweight both the US and Asia ex-Japan markets. In the US, earnings remains the key driver, with growth continuing to broaden beyond just the technology sector. And in Asia ex-Japan, easing energy pressures and strong AI-related demand are supportive. As far as fixed income markets are concerned, we maintain an overweight position in emerging market US dollar bonds, supported by compelling carry and a broadly supportive macro backdrop. And within developed markets, we prefer corporate credit over rates, given resilient corporate fundamentals. Turning to gold, we continue to view it as an important portfolio diversifier. While prices may see short-term volatility as geopolitical risks ease and real yields remain elevated, the longer-term drivers such as central bank demand and its role as a hedge in downside scenarios remain intact. Lastly, what is our key message to investors in this environment? Our core message remains clear: stay invested, stay diversified, and stay nimble. This is not a market where we step away from risk, but it is one where we need to remain thoughtful about where and how we take it. Periods of volatility are likely, and they should be seen as opportunities to rebalance and add exposure, rather than reasons to exit. Thank you for joining me for this CIO Signature Strategy update. I'll be back with more updates soon, and I'll see you then.